Hello, everyone. Welcome to this week's Market Bites episode. My name is Bret. I'm joined, and notably, neither of us are joined here by Sam North, who we both greatly miss navigating this as our host, but we will do our best to get through today's show. Neza, how are you doing today?
I'm doing very well, thank you. And I bet that if Sam was here, we would definitely comment on Champions League. And I know that he's in a good mood today because Arsenal won yesterday. So he has a good reason to celebrate. And I hope that he has lots of fun in Abu Dhabi. But meanwhile, we are your hosts today. So I hope that you will enjoy this episode. And yeah, how are you, Bret?
I'm doing good. I'm happy to hear about Sam's team and hope he's also having some fun. He deserves it. It's very well deserved. But like you said, we're going to do our best to fill in for him today. And today we're going to discuss Oracle. The company reported day, beating on earnings, missing on revenue. Shares open lower by about 15% today. But before we go to Oracle, we're going to talk about the Fed, as the Fed delivered its third consecutive rate cut and its final rate cut of 2025, reducing interest rates by 25 basis points. But there is a lot of moving parts, particularly when we look towards 2026, whether it's with the chairman, whether it's with the macro backdrop. So kind of a lot to break down there, I think, with the Fed. Before we do, Neza, keep seeing this term, this, hawkish cut. Do you mind just kind of explaining what that is or kind of breaking it down for everyday investors?
Yeah, I mean, if we break down in a simple way, a hawkish cut that we saw yesterday, it basically means that Federal Reserve lowered interest rates, but they did it in a tone that kind of signals that they're still a bit worried about inflation and they're not promising anything beyond this move. It is basically them saying, we are cutting today, but do not get too excited about any further cuts because we are just not convinced that yet, and we don't have anything fully under control. I think that Federal Reserve is kind of stuck here because they're in the middle of those two goals that they want to reach, and that's why they're sending those conflicting signals, because inflation is still higher than their goal inflation, and especially core inflation here. And yeah, but when we look at labor data, for example, we can see that the job growth has lowered sharply, and this unemployment for young workers has risen. So we also have these job findings unusually low. So they're kind of stuck between those two problems. And here the main issue is that pushing rates higher to control inflation would damage labor market even more, but cutting too aggressively, that could risk inflation bouncing back if tariff pressure continues. So I think that is why Powell said that there is kind of no risk-free path, because every option increases risk somewhere else. So they're trying to navigate those risks as good as possible. But yeah, when investors say that the Fed is stuck, this is what they mean, because there is no clear direction and every move kind of has their risks associated. So until we don't have more data to see which side is stronger, the Fed will kind of keep walking in this side in the middle to kind of navigate all of those risks. But yeah, I mean, you are our US guy, so you know best on what is happening in the US. And what do you think will happen as we go into 2026? What are those biggest risks and opportunities for the next 12 months? Because there are so many things to navigate, and we are also expecting new Federal Reserve chair. What do you think about all of those stuff?
Yeah, I think there's so many moving parts when it just even comes to the Fed for 2026. I think first things first, I think investors need to remember that rate cuts that come when stocks are near all-time highs tend to be a positive over the long term. So while there can be some noise over the next few weeks or really over the next few months, generally speaking, it to be a fairly large positive. And now that's been our third cut we've got in the last, since September. So really the Fed has taken rates down, I don't know, fairly notably now over the last couple months. That's probably a positive in my eyes. I look at that as dovish. I think that's a good thing. But at the same time, you do have these other concerns about the macro picture, and Chair Powell noted that yesterday, saying there is upside risks to inflation and downside risks to the labor market. And the word I believe he used was tension between their dual mandate, between being stable prices, i.e. inflation, and maximum employment, i.e. the labor market. Both of those metrics are kind of moving in the wrong direction for the Fed. And so from that perspective, I think it does have them in the committee in sort of a tough spot. And he kind of alluded to that yesterday too in the Q&A session, saying that everyone on the committee sees the same problems. They're in agreement on the problems. They're not necessarily in an agreement on the solution to those problems. So some of the committee members want to cut rates more aggressively, and some want to be more conservative. So obviously some members favoring the labor market as a bigger risk, and other members favoring inflation as the bigger risk. And then in between, you get this very indecisive range. When we look at every 4 times a year, every quarter, the Fed gives us their summary of economic projections, basically what their outlook is, their long-term outlook on inflation, unemployment, GDP, and interest rates. And actually, those revisions were an improvement from September. The inflation outlook was a little bit lower, GDP was higher, unemployment was stable. So and interest rates were stable, but it basically pointed to the committee looking at just one cut for next year. The market's pricing in two, so we're not off dramatically. I don't think yesterday's meeting took investors by surprise so much as it would have if they came out and they said we don't expect any cuts next year. I think that would throw people off. But there is not a consensus with the committee. The same amount of people cut said we expect no cuts, and then we expect 2 cuts, and that's before we account for the outliers who were more aggressive in both directions. So there's really no consensus on the committee, and this is all coming with as you mentioned, Neza, a new Fed chairman coming later this year, or in 2026. A lot of moving parts here. I mean, that's the way I sum it up. A lot of moving parts.
And if you would have to say, what would be your bold prediction for next year? Next year moves. Are you expecting more cuts, or would you say no cuts at all?
So not only is the Fed not looking at rate hikes next year, the language in the statement suggests, and it's a little speculative, but it suggests that the Fed is really not in a hurry to cut rates here. They've kind of it feels very 2024, right? Where they kind of hit those last rate cuts into the end of the year, and then they went on pause for 9 months. I don't know if it'll be 9 months again, but I see them taking maybe a prolonged hold here and just kind of seeing how things shake out. How does inflation look early in the year? How does the labor market look? The economic data is still backdated quite a bit from this shutdown. So we are missing a lot of economic data at this point. We'll get a big update next week. But I don't know. Right now it seems like they're going to be on hold, but it's not the worst case scenario we could have seen.
I agree with that. But yesterday, I kind of expected bigger move on the market, depending on his speech or maybe even decision. But I think that everyone was surprised that the big move actually came after the market closed when Oracle reported the earnings, because it moved entire AI sphere. All AI-related stocks were down yesterday, just because Oracle earnings. And here we can clearly see how big impact AI story still has on the market, and especially on the tech stocks, because we saw how Nvidia, AMD, Microsoft, all of those companies, I think that they all traded lower yesterday just because of Oracle earnings. And we can see that how focused the market still is on AI story. And did you follow on what happened with Oracle? Because is it a big shift in fundamentals, or was it anything that big that caused such a big move in the stock?
Yeah, I think when you look at the quarter, we got an earnings beat, a revenue miss, guidance looking forward was mostly in line. It was a fairly solid guide compared to consensus. But I think the thing that really is hanging investors up is really the debt and the cash burn.
Yeah.
Free cash flow burn was twice the rate that analysts were expecting for the quarter. Looking ahead, capex was, I think they pegged at 50 billion, which was up from 35 billion. These are some big numbers to be throwing around, but I actually think it's, I mean, Oracle bulls won't be happy to hear it, but I think it's kind of a good thing that investors are so focused on the cash burn, right? I mean, for all the talk that we get about bubbles and how this is going to end so badly for AI, there's a lot of focus, I think, on the risks of it being a bubble and the risks of the cash burn and the debt and some of the maybe the circular nature of the deals we're seeing in AI. I mean, I think that's investors are focused on the cash burn of these mega cap companies, and it's not just Oracle. I think there's only two mega. There might be a third one that's just kind of back and forth with the S&P, but for the most part, that group is underperforming. And I do think a big part of it is the financial concerns. But to your point, yes, Oracle's report not only weighing on, not only pulling its own stock down, but really weighing on the entire AI trade as a whole. You see, I think Nvidia's down 2 or 3% right off the open. So, yeah, I think those are kind of the main points that I see out of it. What stuck out to you?
Yeah, I was also surprised. And I was actually not surprised on the move, especially when I saw that their long-term debt was up 25% in a single year. And now it sits just like under $100 billion. And on top of that, with negative free cash flow, which kind of would have to support this kind of borrowing, it's negative. So it kind of makes sense that investors are that cautious and they see the risk in it. But yeah, I think that everyone is kind of discussing, do we see a bubble? Do we see, is it kind of a too big of a risk? Is even Oracle this big long-term AI winner, or this was kind of a sign that market is overheating? And yeah, I've been thinking a lot about it today. And I would say that on one hand is kind of Oracle is definitely a beneficiary of AI, and all of the story tells you that, because they have all of these contracts with Meta, Nvidia, and OpenAI. But on the other hand, they are also kind of example why people fear about AI bubble, because their valuations are priced for perfection and they have so big spending, and that is rising faster than cash flow, and all those circular financing in ecosystem, all of those things people are investors are worried about what could happen if they do not deliver what they're promising. So is it really overheating or not? I think that we will only see that after a few earnings reports, because they need some time to deliver. It takes time to develop things that they're promising. But in case that doesn't happen, we could see more reactions like that on the market. I don't know. What are your thoughts on that?
I mean, I think when we talk about a bubble, I mean, I think really, honestly, I think Oracle, as much as I hate to just, I think Nvidia is the exception, but as much as I hate to just take one company and let it represent a whole industry or a whole movement, I think Oracle's price action actually is really does a good job illustrating how investors are viewing this. This bubble, the bubble talk. I know it gets a lot of traction in conversation, but when you look at the actual, price action of something like this, this is not bubble-like behavior. Maybe you could argue we're in the early part of a bubble, and years from now we'll look back and feel that this was early, and we've gone on to have the sort of explosive move that comes with a bubble. But when you look at something like an Oracle, in a real bubble, like if this was 1999, no one would care about the debt or the free cash flow burn or any of the negative financial repercussions that some of these deals can have. They would be cheering this move. They would be bidding this name higher by 15%, not punishing it 15%. And I think even more broadly, when we look around the space, you're seeing Nvidia, who is the poster child for this AI movement, growing earnings and revenue, clocking in at about 50%. Year over year. This name trades at 25 to 26 times it's the next 12 months of earnings. That is not an egregious valuation. If this was a bubble, that number could easily be triple digits.
Yep.
So, And that's not just NVIDIA. You look at someone like an Amazon or a Meta, their valuations are not egregious by most people's standards. So, for me, for this to be, maybe it'll prove to be an early part of the bubble, but for this to become a bubble, to me, we would need to see the valuations become much more stretched, and we would need to see people not care about the financial implications of some of these deals and the debt.
Yeah, that's definitely right. And I think that investors are still very cautious about their earnings because nevertheless, the company could even move 15% higher yesterday after earnings because nevertheless, they achieved a strong, for example, cloud growth, quarter after quarter, because their cloud growth grew by 34%, I think. But it was just lower than what investors were expecting. But nevertheless, 34%, that's not low. And also other numbers that they reported, borrowing was escalating and their debt was not something that investors were hoping for, but overall growth was not bad. And they see more opportunities on the market. So I think that in real bubble atmosphere, they could see more positive points in their earnings, and we could even see the stock price moving higher after their report yesterday.
That's about where I am too. I mean, we there has been, I would say, pockets of euphoria. I think this is, and again, Oracle's a good example. I mean, at one point the stock was up 100% on the year. I can't remember if it actually hit $1 trillion in market cap or if it was just very close. But that was a brief moment of euphoria. Has since come back to earth a bit. Still up nicely on the year. I'm not sure where it's at now, but coming into today's print, it was up like 34% this year. To your point, 34%, not really a small number. So, I think we have seen some pockets of euphoria, and it's actually interesting. I was speaking with someone yesterday, and they're asking me what sort of smaller trends did you see any small trends in 2025 that you think could grow in 2026? And one that stuck out to me was sort of like the offshoots of AI. So like what we're kind of seeing, the whole part of AI. I don't want to say to this point, but the biggest part of the AI move has been sort of in the infrastructure side, the hardware side, the chip names essentially. But now we're starting to sort of see that trickle down into cybersecurity. We're starting to see it trickle into software. Some companies, it's a huge overhang. You look at like Salesforce and Adobe, even though those companies continue to actually put out pretty good results. The worry that they're going to be disrupted by AI has really kept those stocks down and really pinned down those valuations. But we're starting to see it trickle into other areas, even into utilities and nuclear. It's so weird looking at the year-to-date performance and seeing tech number one and utilities number two. I mean, it's historically way out of whack, but under the context of AI helping utilities, it makes sense. But I think that is sort of, as we look to 2026, we can start to see some of those offshoots really start to gain some traction just as AI plays a bigger role, in the business cycles.
Yeah, I think that's a good point because I think, in my opinion, at least, we are in early stages of AI. We are kind of thinking where we can implement it to grow earnings faster. But I think that all of the other sectors besides tech, they're still in the early stages of adoption. Because when we will see on how companies can use AI to grow their earnings, to use AI in their day-to-day operations, to make them faster, more efficient, only that will show us the real usage of AI and what kind of difference it can make. Because nevertheless, we can see major difference with AI in, for example, healthcare companies or any other sectors that are not just tech orientated.
Certainly. And I guess tonight's report with Broadcom will help shed a little bit more light. We're not done with the AI trade yet this year. We still at least have to get through the $2 trillion Broadcom, which, as our prior discussion a week ago says, could maybe be Magnificent 8. So we'll have to see what they say.
Yeah, maybe we will comment on that in the next week episode of Market Bites.
Yeah. Maybe when Sam comes back, we'll get his thoughts. He's he helps lead these very, very well. So until then, thanks for joining us this week. Thank you for bearing with Neza and I as we, navigated without Sam's leadership here. And we look forward to seeing you at next week's episode.
Thank you, guys. See you next week.